Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Madison alongside Julie Hyman. Let's get you the three things that you need to know today.
First up, U.S. stock futures are sinking this morning as investors brace for the Trump administration's tariff deadline. President Trump said he plans to start his reciprocal tariff push with, quote, all countries, curbing any speculation that he could limit the initial scope of the levies. Trump set to launch so-called reciprocal tariffs on April 2nd, a centerpiece of his plan to rebalance global trade and boost U.S. manufacturing while collecting tariff payments to fund his domestic policy priorities.
And the tariff uncertainty prompting Goldman Sachs to cut its target for the S&P 500 for second time this month, with strategists seeing the benchmark ending the year around 5,700 versus their previous estimate of 6,200. The bank's economists also raising their forecast for a recession this year to 35% from 20%. They also see the Fed cutting rates 3 times this year as tariffs weigh on economic growth.
Plus, investors are preparing for the start of the second quarter after the tech trade saw its worst start to the year since 2022, with the Magnificent Seven cohort down 16% year to date. The group of tech stocks extending declines this morning with the broader market as investors brace for reciprocal tariffs.
U.S. stock futures sinking this morning as tariff fears grip markets. The risks posed by the levies prompting Goldman Sachs to cut its year-end target for the S&P 500 for the second time this month, saying if the growth outlook and investor confidence deteriorate even further, valuations could decline much more than previously forecast. Joining us to discuss more, we've got Yahoo Finance markets reporter Josh Schafer. Josh, I know you've been all over this note this morning. Talk us through it.
Yeah, so it seems like these tariffs might actually happen. And now that we start putting that into the forecasting numbers, the numbers don't look as good, right? And I think that's really been the realization that we're looking at across the forecasting space really over the past month, specifically over the past 24 hours, right? So the key to Goldman's call here really, when we think about sort of their economics call, you guys mentioned they raised their odds of recession to 35%. They ticked down their growth forecast, ticked up their inflation forecast. It's about their effective tariff rate number, right? And they put up their tariff rate forecast now to 15%. What does that do to the economic forecast I just mentioned? Sort of creates this stagflationary environment, right? Where inflation goes up, economic growth goes down. What does that do for stocks? Not a good environment, realistically, to have tariffs of 15%. You think back to the Barclays call we talked about last week. They also now see the S&P 500 only hitting 5,900 this year. Also key to that call, Vinu Krishna told us we hadn't really accounted for tariffs at this point yet because we didn't know what to put in there. Now, if we put in a baseline of 15%, doesn't look so hot. Yeah. You look at Yardeni Research, also moving down their S&P 500 called the 6,100. Ed Yardeni wrote countless times throughout that note that, quote, Trump's reign of tariffs have changed the outlook. So I think really you're seeing it in both forecasting and then also S&P 500 futures today, right? And just the general market. We're starting to come to the realization this thing's going to happen on Wednesday.
Yeah.
And there's going to be more tariffs than maybe people had initially thought.
And that the markets cannot strong-arm him into changing his mind, right? Because the so-called Trump put that a lot of folks have talked about, oh, if stocks pull back far enough, he'll blink. That hasn't really been borne out, both in actuality and also in his rhetoric, right? Where he says he's willing to put up with some declines in the stock market.
Well, because also, Julie, I think things have felt chaotic, but when you take a look at how much the indexes are at least down year to date, the S&P 500's off, I think, about 5% this year. Yes, we hit that 10% correction mark from an all-time high, and we hit it pretty quickly. And things have been bad, and I'm not trying to downplay that a lot of people, of course, have lost money in various different stocks. But overall, we haven't come down that far. And so, where is your Trump put number? I would imagine it would probably be significantly lower than where we are right now, right? And I think you're starting to hear more people talk about maybe a bear market. That would be the S&P 500 getting closer to 4,900. And so maybe there's just more of this to play out, I think, and perhaps more selling action, more downside at some point.
And we also just wrapped up the first quarter of the year, obviously. To what extent could this earnings cycle affirm or deny the tariff boogeyman in the room as something that's going to continue to weigh on stocks moving forward?
I think that's probably one of the largest looming questions right now, right? So I highlighted in our newsletter this morning, our chart of the day was a chart from FactSet talking about S&P 500 earnings guidance cuts, right? So they define a cut, or sorry, I should say negative guidance. They define negative guidance by just anything that comes below the street. Well, there's been a little over 60 thus far out of only 100 companies to give guidance. A little over 60 have been negative. That's above your 5-year average, above your 10-year average, and I think the looming question is how much further that number continues to go up. Essentially, analysts were very optimistic coming into this year, and we're seeing that re-rating start to happen right now. But I would think as you go through the next month, we really have earnings kick off next week, right?
Yeah.
I think you're probably going to see more cuts, and then you sort of get to okay, where are we now? Where is the reality situation? And I don't think we're getting that answer on Wednesday, and we're probably not getting that answer at the end of the week. I think that's sort of the looming message from all of these calls too is, okay, this is the start of it, and now we're entering into longer term of uncertainty while we try and sort of price this out.
Yeah, I heard a really good point from Lori Calvasina over at RBC in an interview this morning where she was asked about the so-called hard data versus the soft data, right? The survey data, what we say we're going to do, versus the hard data, what we actually do, what we actually spend on. And she said, well, you have those traditional macro data, but she said, we as strategists have our own hard data, and that's earnings, right? And that data has not been great so far. What we have heard from companies, particularly consumer-facing companies, has been that they're concerned. And so now we're going to get more from a broader swath of companies to see if they confirm that.
Well, and I think even relating that to the market action too, Julie, the most interesting part of this sell-off to me has been, we keep talking about the tech sell-off and sort of where the concentration has been in the selling action. Well, if we're afraid that wider tariffs are coming than we initially expected, my question is, how much is that impacting tech versus perhaps maybe impacting some of those consumer companies more? Yes. And then when you think about there maybe being more selling to happen there on a company-specific basis, I don't know if we've seen all of that priced into the actual companies that are going to be impacted by tariffs the most. You look at Staples doing pretty well this year. I'd guess consumer staples are going to have a hard time if we slap tariffs on everyone, right? Yes. And so I think that part of it and that piece of it, we saw this with autos last week, right? You thought, okay, we've talked a lot about these auto tariffs. We're sort of ready for this. GM stock didn't really look like it was ready for the level of tariffs that we eventually found out, right? And so I think when you think about where the market's at with what we're expecting to hear versus what we're actually going to hear, it seems like, at least on an individual stock basis, certain stocks have struggled with the actual number.
To your point, the worst performer in the S&P 500 this year on a percentage basis, I'm not going to tell you what it is. It's a consumer discretionary stock. It is not a tech stock. And we're going to tell you what it is a little bit later in the show.
So it's not Tesla.
It's not Tesla. It is consumer discretionary, but it's not Tesla.
That's a deep tease. I'm staying tuned in.
It's more in the consumer realm.
Okay.
We'll talk about it later. You got to keep watching, and so do you, everybody else. Thanks, Josh. Appreciate it. Well, President Trump said over the weekend the reciprocal tariffs coming Wednesday will include all of the U.S.'s trading partners. You'd start with all countries, he told reporters aboard Air Force One. The president has previously referred to April 2nd as Liberation Day, but details are scarce. Here's what we've been told will happen on Wednesday. Reciprocal tariffs and levies on external agricultural products will be enacted. Also, tariffs on goods from Canada and Mexico will start again. Joining us now, Jeanette Lowe, Strategas Securities Managing Director of Policy Research. Jeanette, obviously we won't know until we know, right, on Wednesday, and we get these, and we might not even know then, right? There might be some moving targets. What is most important for investors to be watching for on Wednesday?
So good morning. There's a couple of things. I think, first of all, as you've said, there's been a lot of conflicting headlines over the past couple of days. Maybe the administration hasn't even quite determined what its ultimate plan will be on Wednesday and what they're going to announce. You know, we've had last week a lot of talk from President Trump saying that he's going to be more lenient. Now it sounds like he's being much more aggressive. Maybe that's to make it more onerous before that deadline actually hits and then it becomes better. But what is the scope of action is actually announced is going to be important? Is it reciprocal tariffs on all countries, or is it phased in, kind of going after, you know, that dirty 15 that the Treasury Secretary has been referring to? Does he also announce other sectoral tariffs, like maybe on pharmaceuticals on Wednesday? That would be important. If the USMCA tariffs on Canada and Mexico come back into effect, that's even more significant. So we're continuing to build up here. He already talked about how he wants $600 billion of tariffs over a year. That's 2% of GDP. That's basically amounting to a doubling of the corporate tax rate. So this is quite significant if we actually get the full ballast of everything that he's been talking about so far.
So, Jeanette, if you're reading the tea leaves when Trump is talking about these universal tariffs on other countries, for example, do you think that that is a escalate to de-escalate strategy, or is this a real potential clearing event that is as potentially negative for the market as investors are acting this morning?
Yeah, so this is important because what we've seen is from reciprocal tariffs, originally Trump said he just wants it to be fair. So if other countries are charging a higher rate on products than the US is charging, he wants to raise those rates to even out the playing field. But then he also said that he also wanted to include VAT taxes in these tariffs. He also wants to include other non-tariff barriers. So maybe that's regulatory changes, maybe that's subsidies. So if you put all of that together, reciprocal tariffs on their own aren't necessarily that impactful, but trying to incorporate other countries' VAT taxes is going to be much more significant. So we're looking at maybe like 50 billion for reciprocal tariffs, 165 billion for VAT tariffs. That's important. Also, it would, if it's reciprocal, other countries might have a chance to negotiate. They might be able to lower their rates to then get rid of the tariffs. But if you're putting a tariff on other countries' VAT, that's basically becoming a permanent tariff. It looks much more like a universal tariff overall. And that's going to be much more difficult. Other countries are going to be unlikely to either cut or reduce or repeal their VATs. And that's going to be much more significant for the markets than I think reciprocal tariffs alone. The other thing is, does he move to more of a universal tariff? And is that rate more 20% or 10%? 10% would be much more manageable. That would actually be less than the impact of having reciprocal tariffs and a reciprocal VAT on other countries. 20% would actually be higher. So where those numbers come out is going to be really important for how the market judges this going forward.
Jeanette, just to take a little bit of a pause here, VAT, value added tax. For people who aren't familiar, why is that different from the other tariffs, potential tariffs that we're talking about here? Can you explain that a little more?
Right. So most every country has a value added tax. So this is a tax on consumption. There's a rebate for exports. So it allows exports to leave the country without having that tax on it. So technically all goods coming into a specific country have this value added tax. The U.S., basically, the president has been seeing that the U.S. cannot impose its own value-added tax in reciprocation. So he feels like this is unfair to U.S. imports into those countries, and he wants to account for it. Now, people could argue whether or not that's the right way to look at it, but that's what we think he is ultimately trying to do. So we think that he actually may try to just apply a tariff that would account for the same VAT rate that other countries apply on imports into their country or all goods in their country, and he would apply it on imports coming into the U.S., but still providing a rebate for exports. But this is a way for him to say, I think that other countries are disfavoring U.S. products, and this is how I want to fix it.
To what extent do you think, Jeanette, there is something that could regulate the president's efforts when it comes to tariffs? I know we've seen reporting this morning that we may see a bailout for farmers, obviously widely represented by Republican lawmakers. Could the midterms be something that come into play and you see more congressional pushback, or what do you think that pushback might look like?
So I definitely think that if you start to see more voters unhappy with the president's agenda, that could have some impact on making him be more lenient in the future. I think one other thing that's quite important is the fact that we're going to have 2 special elections in Florida on Tuesday, the day before this tariff announcement. Those are very strong Republican seats. They are 30 plus districts where Trump won and the Republican candidate won in November. But if the Democrats were to take one of those seats or potentially really close that gap and make it much more narrow, that could also change his thinking a little bit as he goes into April 2nd. But I think obviously the market will have an impact. I know that there's some times that he says it does not have an impact, but I think ultimately overall that will start to play into his thinking here.
All right, Jeanette, we got to leave it there. Thanks so much for setting up the week for our investor audience. Appreciate it. Coming up here on Morning Brief, we're going to count you down to the opening bell on Wall Street as stocks looking to open firmly in the red on the final trading day of the first quarter. Plus, we'll dig into the biggest movers of the day and look at the Mag 7 names most under pressure. You can see one of them on your screen here. And stick with Yahoo Finance this morning. We've got an exclusive interview with AMD CEO Lisa Su at 10:30 a.m. Eastern. You won't want to miss it. It's now time for some of today's trending tickers. You can scan the QR code on your screen to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, shares of Tesla taking some losses this morning, down nearly 6% amid a broader sell-off here. CEO Elon Musk saying over the weekend at a Wisconsin town hall meeting that was greeted with protests that he puts the blame for the current slump on his role at Doge. Musk saying, quote, "It's costing me a lot to be in this job. My Tesla stock and the stock of everyone who holds Tesla has gone, well, roughly in half. I mean, it's a big deal." So we have a lot of that commentary coming in from Elon Musk here, admitting to the fact that it is costing him a lot. He also reiterated this call that he put out previously that a magic 8-ball could do a better job than the Federal Reserve, something that he has said before. But I think what's also obviously moving the stock this morning is this call from Stifel amid the broader sell-off as well, talking about reducing their near-term delivery forecasts to reflect the rollout of the new Model Y Juniper, as well as those headwinds from the anti-Elon Musk crowd. So pointing to both the political and also some of the product challenges.
Yeah, I mean, there are some analysts out there who say it is because of that Model Y changeover that's the real reason behind a lot of the slump in the deliveries in the last couple of months. But here it is Musk himself acknowledging that, yes, people hate him right now and are protesting at Tesla dealerships all over the country because they are upset about what's going on at Doge, and that is likely having an effect on the sales. I mean, there is also, as you pointed out, this broader downward vibe here that's affecting the Magnificent Seven this morning. You know, certainly affecting Tesla as well. And then there's also what's going on with the tariffs. And even though Tesla is less exposed to the tariffs than many of the other U.S.-based automakers, because Teslas are assembled in the U.S., they do get parts from other places and raw materials from other places. And this weekend, we had President Trump saying in a phone interview with NBC, he couldn't care less if automakers do raise prices because of tariffs. That was contradicting an earlier report that the Journal had that said he had threatened automakers and told them not to raise prices in the face of tariffs. So, you know, we've got some of the automakers under pressure as well ahead of the actual imposition of the tariffs, right?
Yeah, and where do you land when it comes to the president's thinking when it keeps continuing to change? You're kind of chasing the ball there. I thought it was interesting to your point on whether or not tariffs will be a huge headwind for Tesla. Elon Musk broke, I think, a 3-year streak of not posting about tariffs specifically. Last week, he finally did post about them and said that they would be potentially negative for the stock. So something that we will continue to talk about.
Yes, we will, indeed. All right, next, Moderna shares down nearly 12% amid reports that FDA official Peter Marks, who oversees vaccine development, will step down from his position effective April 5th. The ouster also dragging down other biotech stocks this morning. Here with more, Yahoo Finance's Anjali Kamlani. So, Anj, what does this mean for Moderna and other vaccine makers? What are the implications of this change?
Yeah, really, it just throws a lot of uncertainty into their future. Any company looking for approvals or any kind of other milestones, their trajectory is now put into uncertainty. And while Peter Marks' resignation was not entirely a surprise for Wall Street, you can see the impacts on stocks like Moderna, like Novavax, like Vaxcyte, dropping the most there at more than 30%. So these companies are the ones that are most at risk, not just because of Marks leaving, but of course, we've reported previously with the new HHS Secretary, Robert Kennedy, as well as FDA new lead, Dr. Marty Makary. Those folks have been, throwing some uncertainty into this sector because of their stances on vaccines. So it's uncertain how much more research dollars are going to go into the sector, how much more these contracts that they have with the government, some of these companies in developing certain vaccines, what happens to those in the future. It's important to note there's also other companies that are potentially at risk. I mentioned those that have upcoming milestones. Gilead is one of those, down more than 4% today. And we heard a little bit from the street about how this wasn't necessarily a surprise, but still has that level of uncertainty. Looking at Leerink Partners earlier today with a note saying that they believe that the higher multiple biopharma stocks are at greater risk than lower multiple stocks due to potential downward pressure. And then Mizuho Strategies taking a step back, talking about how, many believe that Mark's resignation is a bad omen for the healthcare industry and innovation at large, but it may be a little premature to cast that dark shadow on the future of the two subsectors. So there you have it, just taking a look at, uncertainty, yes, maybe pull back. We don't know who is going to replace Peter Marks and how they will choose to negotiate or relate to the current leaders in the administration.
Yeah, and Anjali, obviously another huge focus for this administration is a pullback in funding, including almost $28 billion in global health initiatives that the Trump administration does plan to cut. To what extent does that federal funding getting dialed back potentially lead to even more headwinds for some of these stocks?
Yeah, this is also where, global aid for vaccines, global aid for any kind of treatments is also at risk. And we've talked about that with Robert Kennedy and what he could do, the levers that he could pull with regard to this. HHS oversees a lot of these programs. And so how the administration is going to act moving forward is still under scrutiny. We do not know a lot about that. And that's sort of one of the comments I saw from Wall Street, is that there's been a little pullback in transparency in what's going on in these organizations, in these departments. And so with greater transparency, we will actually get to know the answers to your question.
Thanks, Anj. Appreciate it. Well, finally, it is the last day of the first quarter, so we want to take a look at some of the best and worst performing stocks and sectors of the year so far. Consumer discretionary, the worst performing sector. And I talked earlier about what was the worst performing stock in the S&P overall, not just consumer discretionary. It's Deckers, owner of Uggs and Hoka. That is the worst performing stock in the S&P 500. It's joined by Tesla and Las Vegas Sands, which have also been the worst performers in consumer discretionary this year. I teased this earlier, Maddie.
Great tease.
That this company came out with its earnings earlier in February. Disappointed with its forecast, and the stock has not recovered since. In fact, it has just continued to go down, even though analysts broadly still like it. I ordered a pair of Hokas for one of my kids this weekend.
Did.
We are a big Hoka's household.
There you go.
Hoka's sales actually were up 24% in the quarter that they reported, but still there's concern about what's going on with this company going forward. And consumer discretionary, obviously, when we're seeing these consumer sentiment surveys that are weak, yes, Tesla's a big weight within that sector, of course. But there's also a close eye that people are keeping on these other stocks to see if they're being affected by all this.
And I wonder to what extent some of that negativity around tariffs is getting priced into some of those consumer discretionary names. And maybe the hope is that over time, the real impact is not going to be as bad as is getting priced in right now. Maybe a lift later. But of course, that remains to be seen. I did want to take a look at the good news for the quarter here. CVS is the top performing stock in the S&P 500 so far this year, with healthcare bouncing back from its position as the weakest sector in 2024 to the second best performer year to date, lagging only energy. And what I think is really interesting, obviously, CVS is down today, but it seems like the best performers in the S&P year to date so far are just the underperformers from last year. So perhaps that's a little bit of a rebalancing versus any positive catalysts for this individual stock. I should mention CVS has gotten quite a few price target hikes as of late. They've now got about 70% of the street with a buy, 30% with a hold rating on the stock. So getting a little bit of more positive momentum off the back of thoughts about them being able to handle their balance sheet a little bit more effectively, some potential M&A activity moving forward here for the company, slashing bonuses as well. That was another positive catalyst over the quarter, but no huge fundamental change in the business that has a growth story attached to that would make it the best performer in the S&P.
Right. I mean, we know that some people have migrated to some parts of healthcare as a sort of defensive posture. So that could certainly be part of the situation as well. I believe they got a new CEO late last year, so there's also some hopes that he's going to start to turn the company around.
Yeah, healthcare, financials, energy, some of the safe havens amid.
On a relative basis.
On a relative basis.
I guess so. Yeah.
Very well said.
Yeah.
Yes. Well, when we come back, we're going to be bringing you the opening bell on Wall Street. Stick around for that next. And you're gearing up to hear your opening bell on Wall Street here. That is the opening bell for this Monday morning here. Let's do a quick check on the markets to kick off your trading day on Wall Street here, because stocks are still firmly in the red this morning off the back of that announcement over the weekend from President Trump that there may be reciprocal tariffs on all countries. Perhaps this digestion in the market of the fact that these tariffs are serious is starting to weigh on stocks more broadly. You've got your S&P 500 down about 1% here. I just want to take a look at the intraday action this morning for you here. You've got your S&P off about 1%, your tech-heavy NASDAQ NASDAQ responsible for the majority of the selling here. And I do want to take a look at our Mag 7 names in particular because all 7 of them are in the red. As you can see, NVIDIA and Tesla, the biggest laggards here. So obviously those big tech names are heavily weighted on the index, so they're going to have a huge impact on where stocks head throughout the rest of your day. Also want to mention Palantir, by the way, a lot of selling there, down nearly 7% at the moment as the market opens here. But also it's interesting to take a look at the S&P 500 as well. It's down about 9% from its prior highs. So we are on a little bit of correction watch for the S&P 500 here. If you take a look at a broader chart, you can see the huge dip the S&P has had over the course of the last couple of months. Julie, I'll hand it over back to you.
Thank you. It's time now for today's strategy session. The tech trade seeing its worst start to the year since 2022, with the Magnificent Seven cohort down 16% year to date. A tough start to the year coming after the group rallied 67% last year. Joining us now on what to expect for the sector going into the second quarter, Dave Mazza, Roundhill Investments CEO. Dave, it is fantastic to see you this morning. Thanks for being up bright and early for us. So as we look at the Mag 7, really it's been split among the strategists that we've spoken to as to whether they are still sort of all in on big tech or taking a step back. How are you thinking about it, since this has really seemed to be the risk aversion barometer that has been very sensitive this year thus far?
Yeah, we know the Magnificent Seven stocks have been the market generals now for some time. And sort of when the generals are wounded, it's hard for the rest of the market. It's hard for the soldiers to really carry the torch forward. And one of the reasons why we're seeing sort of this bifurcation of, to your point, folks remaining pretty bullish on this group and pounding the table that this is a great buying opportunity, and those that are really getting extra cautious is just due to the amount of unprecedented uncertainty that we're seeing. Just look over the weekend. We're now, the Wall Street Journal is reporting that there could be 20% tariffs, 20% tariff rate across the board, something much more aggressive than I think even sort of cautious investors and traders were pricing in even on Friday. So the rate of information that we're having just about things that investors and companies themselves can't control is growing, and that has made it sort of a difficult environment to navigate.
It's certainly difficult, but we are going to ask you how you're navigating it, Dave. Where are you finding opportunity right now? And is any of the dip looking attractive to you? Are there any areas even within tech that you're buying right now?
Yeah, so it's interesting. So we're seeing this disconnect between hard data and then soft data. So by soft data, I mean surveys, and particularly the consumer surveys, have really fallen off a cliff. But to date, hard data, so employment, inflation, have not rolled over, are not necessarily bad. Earnings, of course, last quarter were pretty strong. I think I actually expect to see some strong earnings again, especially out of the tech side in the upcoming earnings season. But right now, we're very cautious. So I think boring is better in the very short term if we're sticking with the U.S. So staples and utilities come to mind. Of course, we know they've held up a bit better because what we're seeing is just sort of a wave of sort of weaker hands. Some of that is sort of momentum investors, whether that's retail investors or hedge funds, who was selling very aggressively. But at the same time, and we're seeing this with our ETFs, there's still sort of a bid in the markets. So people are still allocating to equities, but they're doing so while the share price continues to decline at large. So at some point, that certainly could stop. But again, better is boring for the very short term. But I do think there's going to be some opportunities for sort of those high quality Magnificent Seven names as we get into earnings season, and they can again prove that they're the areas where there's growth coming from, not other places in the equity market.
Dave, what about tech outside of the U.S.? Speaking about China, big tech in particular, I know that the KWEB, which is an ETF that tracks China tech, has pulled back a little bit. But is that an area perhaps that investors should be looking also?
Yeah, so if people who are looking outside of the U.S., China tech, I think, is a really prime area for investors, especially sort of the Magnificent Seven equivalent stocks in China. And here's why. I think we are sort of now realizing that sort of it's a tale of two worlds, and meaning there's going to be a bifurcation between Western tech and then China tech. But these names, one, just their size. Their trading volumes, sort of, they separate from the pack. So these big names in China, these big tech names, are where there's an opportunity. To your point, the names had a huge rally. They have pulled back a bit. I think it could be a better time to step in because really although there's a ton of uncertainty what trade policy is going to look like, actually the path forward right now for China tech, some of its evaluation story is just a lot cleaner in the near term here than it is for U.S. tech.
Well, going back to U.S. tech then, Dave, we've got another name in the bunch with CoreWeave's IPO. How are you thinking about a name like CoreWeave and how it's been performing since going public?
Yeah, well, since going public, I think it's probably been a bit disappointing, or at least the sentiment that we can receive from how the IPO was priced. But I actually think, crazy to say, this is a sign that we're not really in a bubble behavior. And in bubble behavior, I think investors would have just totally bid up CoreWeave. They, of course, would have kind of been oversubscribed. We know that the price that came to market was probably closer to reality. Some folks are still concerned about the valuation there. But it did bring a lot of supply into the market that tech investors probably weren't necessarily prepared to handle because of that. But that's a name that I think firmly fits in the generative AI space, has sort of a strong bullish case for it. But in the near term, again, unless you have pretty strong hands, I think we're going to see a lot of volatility and uncertainty from AI names, from AI adjacent names, and sort of other areas, whether it's quantum computing, that are sort of connected to that trade. As investors just begin to really kind of take both their chips off the table and be a lot more cautious of where they're allocating.
Dave, I am curious, though, if there is any bigger read-through. I mean, you were talking about how you're optimistic around big tech earnings when they come. Any concern that something like CoreWeave or some of the analyst chatter that we've heard means that there's a possibility that some of these companies could say, maybe we're trimming our AI data center spending plans a little bit? Or do you think that they're really focused on the long term and that's not going to be a change?
Well, I actually think that the companies themselves, certainly there's chatter to your point. So I'm not going to poo-pah that statement. And that's the reality, because a lot of folks are certainly concerned about what the data center build out is actually going to look like. I think the reason the stocks are actually under so much pressure is the companies themselves are seemingly going to continue to push forward with this long-term investment. It is an arms race to build up the requirements that's going to be needed for AI, large language models in the future. And so right now, the hyperscalers and other companies are plowing CapEx into this space. I don't think that's going to change, barring sort of if we move from the vibe session to an actual recession. The challenge is investors are now weighing how much are they going to pay out for that spending when we're not seeing the ROI yet. To be fair, we were expecting to start seeing some ROI, particularly out of names like a ServiceNow or a Salesforce, who made really a big push into integrating AI into their platforms, helping which the goal of driving revenue at the top line. We're not seeing that yet. So as the sort of return on investment period gets pushed out, coupled with the unprecedented uncertainty that we're seeing from the political side of the political side of the house, it's difficult, I think, really to sort of make a hard case to keep paying up for a high multiple for growth that actually may be stagnant, even though high on a relative basis. So this sort of discomfort that we're seeing investors have toward tech, I actually think is rational for the time being, as we need to kind of see how these headlines shake out.
Yes, we do. Dave, thank you so much. Good to see you.
Thank you.
As we head to break, let's take a look at shares of Rocket. The online mortgage provider is acquiring Mr. Cooper in an all-stock deal valued at $9.4 billion. It'll create a mortgage behemoth that handles 1 in every 6 mortgages in the U.S. That combined company will service a book of $2.1 trillion of loans and nearly 10 million clients, according to a statement Monday. I'll sit down with the CEO at 11:30 a.m. Eastern time to talk about that deal. It also, by the way, comes on the heels of Rocket's announcement it's going to buy Redfin. So really building out and building up the company. We'll talk to the CEO about it. Much more ahead on Yahoo Finance.
Let's get a quick check on the markets here because the selling is continuing this morning. You've got your S&P 500 continuing to move to the downside, taking out its prior lows. The prior low was 55.21. That was the prior market low for the S&P 500. And as you can see, we are hovering around 5,500. So taking out that prior low here. You've got your tech-heavy names being responsible for a lot of the losses this morning. Your tech-heavy NASDAQ down about 2.3%. We are on track for the worst quarter for the S&P 500 since Q3 of 2020. 2022. Also on track for the S&P to have its worst quarter compared with the rest of the world since the 1980s. So seeing a lot of that wrap of the U.S. exceptionalism narrative coming into play when you take a look at the equity flows as we wrap the quarter.
Well, policy and economic uncertainty prompting Goldman Sachs to once again cut its S&P 500 year-end target to 5,700 and raise recession expectations. Bank of America Securities downgraded its GDP forecast to 1.5% and raised inflation expectations. Joining us now for more on where the economy is heading as we await Friday's jobs print, we've got Aditya Bave, BofA Securities senior U.S. economist. Aditya, the cuts are piling up here to GDP forecasts and the recession expectations ratcheting up. Ed Yardeni was another who raised his recession probability this morning. What's your current thinking around this? I know you recently did cut that GDP forecast. As we get ever closer to this tariff announcement on Wednesday, what's your current thinking around the impact?
Good morning. Thank you for having me. So we basically see the recent data flow as stagflationary, which means weaker economic activity, but higher inflation. What we have in our forecast right now is about 1.5% growth in the first half of this year. The risks to that are a little bit to the downside after Friday's data. We're tracking around 0 on first quarter GDP growth. That could set us up for a rebound in the second quarter, particularly if some of the weakness in consumer spending is weather related, then you can get a rebound in the second quarter. But the risks to that 1.5% number are to the downside. That being said, we don't see this as a recession. We see this as a soft patch. Nominal spending still looks okay. Most importantly, the labor market is holding up, and I won't give up on the U.S. consumer as long as the labor market holds up.
I'm fascinated by that, Aditya, because you talk about this in your note, too. You talk about how there's been this resilient consumer since 2021, and the behavior is at odds with the sentiment and the data. To what extent does that make this kind of soft data less important in your view when we are sussing out the health of the economy?
So as far as the consumer goes, I wouldn't pay a lot of attention to the sentiment data exactly for the reasons you said, that since about 2021, there's been this stark divergence between what people say and what they do, right? So there's a lot of expressed concerns about the economy, particularly kind of in a forward-looking sense, but people keep spending. Right, so spending has grown at a 2.5–3% rate for an extended period now. So we would really focus on fundamentals, and I think consumer fundamentals are really a function of the labor market. The other stuff, including sentiment, balance sheet, we're much less worried about all of that.
Aditya, I get the argument between hard and soft data, but what about what companies have been saying, and particularly consumer-focused companies, right? When you get, Lululemon recently stock tumbled after it warned on the year. You've got the likes of Walmart. Are you factoring that in at all in terms of what you're expecting for consumer spending?
We do, and what we would be most concerned about here in the near term is CapEx, right? So when it comes to business sentiment, we do pay more attention. And the concern here is just the uncertainty around tariffs. Not so much the tariffs themselves, but the uncertainty around tariffs creates an environment where businesses are a little bit frozen. It's hard to allocate capital. That could lead to a slowdown in CapEx in the first half of this year. That being said, once you get to the second half of the year, we do think that businesses will be more focused on potential tax cuts, full expensing of CapEx coming back. So as the conversation rotates from tariffs to fiscal policy, I think the CapEx environment will improve as well.
And what gives you the confidence, Aditya, that our economic backdrop is strong enough to withstand a first half of the year that could have significant pain from those tariffs in order to get to the policy dessert that's expected to come with tax cuts?
So again, I'd go back to the labor market. Inflation is
but what
picking
if that
up, but
what if that starts to change, Aditya?
Then I would get a lot more concerned. If the labor market were to start to crack, I would get a lot more concerned. As long as we're generating job growth, we're generating income growth, and then there's room to spend.
Got it. Your recent note did talk about stagflation, right? And that's something that we've been hearing a lot. And to be clear, stagflation doesn't necessarily include a recession. It's a slowdown, right, with an uptick in inflation. Do you think that's sort of the base case here, is that we are going to see stagflation?
Yes, some mild version of that, right? Degrees matter a lot when it comes to stagflation. So if you have 1970 stagflation, which is certainly not our base case, that would be much more concerning. What we have built into the forecast is, you lose about a percentage point on GDP and you add something like that onto inflation, maybe a little bit less, right? That's not the end of the world. That's a cycle in which the expansion can continue. The Fed probably has to stay a little bit hawkish, but the decisions don't become so difficult for the Fed either. Now, if you go further down that road and you have close to a recession with 4 or 5% inflation, then I think the world becomes a much more unpleasant place.
How hamstrung might the Federal Reserve be given some of the movement that we're seeing, particularly at the front end of the yield curve right now? Do you think that that makes it harder for the Fed to be able to respond to any potential climb in unemployment that we might see down the line?
I think the way the Fed is signaling this is we have a good sense of what we're going to do at the next meeting, and we're not concerned enough about the downside to the labor market, or alternatively, we're concerned enough about the upside to inflation that we don't want to cut, right? And beyond that, we just don't know. So there's no point making a strong statement. So for now, what they're telling us is a May cut looks really, really unlikely unless something were to seriously change in the data, but we're not going to make any commitments for June and thereafter. And I think that's the tone you'll hear again in May. Let's say we go into May with similar data as we have now, then they're going to say, look, June looks unlikely, but we really don't know about the second half of the year. So the Fed, I think, really wants to maintain as much optionality as possible right now.
All right, Aditya, giving us a lot of clarity. Thank you so much for joining us this morning, making the time. We appreciate it.
Thank you.
We've got all your markets action ahead here on Yahoo Finance, so stick around for more. You're watching Morning Brief.
Stocks are underperforming so far this year, with all three major averages in the red to wrap up the first quarter. But the big outperformer this year, commodities. Energy is clocked in as the biggest gainer year to date. Here with more, Yahoo Finance senior markets reporter Ines Ferre. So energy stocks doing well and underlying prices.
Yeah, that's right. And we have seen that energy stocks have been the leaders for this year-to-date gains. As we take a look at the Wi-Fi Interactive, let me just show you our chart for the sector action. And you can see that XLE is up 8.5% year to date. So outperforming healthcare, utilities. And this is something that we've seen this rotation going out of tech, out of high growth, and going into energy and dividend yielding stocks, despite the fact that oil is relatively low year to date. It's negative year to date.
And Inez, I know you're also taking a look at gold, obviously hitting how many record highs so far this year now? It's 18?
It would now be 18. Today's 18? Is 18.
18 as of today. So how much more room to run might there be? What are you looking at?
So look, gold right now is up above $3,150 for the futures. It touched $3,127 for spot gold. And geopolitical tensions, trade war, sticky inflation, the risk of stagflation, all of this has been sending gold prices higher. And you have now Wall Street that's been playing catch up with their price targets. So you've got Goldman Sachs is saying by year end, 3,300 per troy ounce for gold. You've got Bank of America predicting 3,500 even. JP Morgan the other day just floated the idea. They did not raise their price target to 4,000, but they floated this idea of 4,000 possibly, because of the speed at which we have seen gold going higher, going from 2,500 to the 3,000 level, now to the 3,100 level. And you have Société Générale, the French bank, that's saying that the central bank buying has really been increasing so much. And you could see 4,000 because of the Russian frozen assets. If those are to go to Ukraine, you're going to, for Ukraine rebuilding in a type of settlement, then you're going to be seeing central banks continuing to accelerate their buying of gold. But one warning sign is that we are seeing gold at all-time highs. And one of the banks, Goldman, the other day said you could see a better entry point going forward, because if stocks continue to underperform, if stocks go down, you're going to see margin calls, you're going to see traders that are going to be selling anything that they can, and that is a scenario where you can see gold going down.
What about the miners? They tend to sort of magnify the move in the underlying commodity, it feels like. Is that what we've been seeing?
Yeah, well, as far as the miners are concerned, they had an underperformance back in 2024 last year. In 2025, though, we have seen them outperforming. So if you take a look at our Wi-Fi Interactive, this is a year-to-date chart. You're looking at a 28% gain for Newmont. You're looking at Barrick Gold up year-to-date. You're seeing gains of double digits, up 23%. So you are seeing them with unprecedented profit margins, really. You're seeing them with improved cash flow. So today, this year-to-date, this quarter, they're really outperforming.
All right, and that's a great breakdown. Thank you so much for joining us this morning. That's going to do it for the morning brief. You can join me in the next hour for more analysis on Catalyst. Stick around.